In South Korea, the average bank transfer takes under 3 seconds. Any time of day, any day of the year, including public holidays. In the United States, the average ACH bank transfer still takes 1 to 3 business days. That gap is not a minor technical footnote. It represents an entirely different philosophy about what money is and how it should move. So how did a country the size of Indiana build a financial infrastructure that, in speed and mobile integration, leaves American megabanks looking like relics? And why, despite all of that, do Korean banking apps still carry a peculiar burden that most Western users would find completely unacceptable? The statistics paint a striking picture. According to the Bank of Korea, mobile banking transactions in Korea exceeded 1.4 billion per month as of 2023, in a country with a population of roughly 52 million people. That is more than 26 transactions per person per month, conducted entirely on a phone. A 2023 report from the McKinsey Global Institute ranked Korea among the top 3 countries globally for real-time payment adoption per capita, alongside India and Brazil. Meanwhile, the U.S. Federal Reserve only launched its own real-time payment rail, called FedNow, in July 2023. A system Korea's equivalent had operational before 2010. Korean internet banking penetration sits at around 74% of all adults, according to Statistics Korea, compared to roughly 57% in the United States per the FDIC. And according to a 2022 OECD digital government report, Korea scores among the highest of any member nation for integrated government and financial digital services, meaning tax, pension, and insurance data talk to your bank in ways that are rare elsewhere. The roots go back to a national crisis. After the 1997 Asian financial crisis devastated Korea's economy, the government made a deliberate strategic bet. Digital infrastructure would be the engine of recovery. Broadband internet was subsidized and rapidly expanded. By the mid-2000s, Korea had among the fastest and most widespread broadband networks in the world, according to the ITU. Banks, forced to modernize or lose relevance, invested heavily in digital-first architecture from the ground up. Crucially, Korea also implemented a unified national ID system, the resident registration number, which gave banks a single trusted identifier for every citizen. Authentication was therefore centralized and reliable, something that allowed financial apps to verify users instantly in ways that fragmented Western ID systems could not easily replicate. The government further accelerated change by licensing internet-only banks. KakaoBank launched in 2017 and acquired over 10 million users within its first year, according to KakaoBank's own published disclosures. Regulators created sandbox environments where fintech companies could test products with real users before full legal frameworks existed. Speed was a policy choice, not an accident. But there is a shadow side, and it is significant. For years, Korean banking apps required users to install an additional piece of software called an ActiveX plugin, a Microsoft technology deprecated by most of the world by 2015. Even as late as 2019, major Korean government and banking websites still depended on it, making them incompatible with modern browsers like Chrome or Firefox on non-Windows machines. The reason was a 2005 government mandate that had required ActiveX as a security standard. A well-intentioned but ultimately catastrophic lock-in. Mac and Linux users were effectively excluded from online banking for over a decade. That mandate has since been dismantled, but its legacy reveals a deeper tension. Korea's top-down, government-driven digital speed created innovations rapidly, but it also created technical debt and compliance burdens that are slow to unwind. Cybersecurity researchers, including those cited in annual reports by KISA, the Korea Internet and Security Agency, have consistently noted that the complexity of Korean banking app security layers, built on older frameworks, creates attack surfaces that simpler Western app architectures may avoid. The lesson inside the success is that moving fast under central direction sometimes means moving fast in the wrong direction. Korea's banking story is ultimately a lesson about the relationship between state direction and technological momentum. When a government decides that digital finance is infrastructure, as essential as roads or electricity, It can compress decades of development into years. But the same centralized authority that creates speed can also freeze bad decisions into law. The United States, by contrast, has a fragmented regulatory landscape. 50 state regulators, multiple federal agencies, which slows coordination but also prevents any single bad standard from becoming universal. Neither model is simply better. What Korea demonstrates is that the choice of a national digital identity system, made early, determines the ceiling of what financial technology can achieve. Countries still debating that foundational choice are watching a real-world experiment play out in real time. The infrastructure decisions a society makes in a crisis become the walls it lives inside for a generation.